Hello, everyone. It's Mitch Goldberg here. You're watching Be the Boss of Your Money. This is my live stream that I do every Monday through Thursday at 4:30 p.m. We talk about personal finance, investing, the economy, business strategy, all of these things that you need to know to be the boss of your money. I take it kind of seriously, but I don't take it too seriously. So, be the boss of your money. Be the boss of your money. It's a live stream. It's just my own little show, and I have so much to talk about with regard to personal finance and investing and all these other great things. So, what I want to do first and foremost is welcome all of you. I want you to get a lot of value out of this live stream. So, if you have any questions, definitely hit me up in the comments. That is the best part. That's the best part of doing this. When you ask me your questions in the comments, of course, words of encouragement, words of wisdom, and shout outs are always appreciated. And if you're watching this in the replay, I'd like to welcome you as well. Certainly hit me up with your questions in the comments, and I will see those and I will answer those as if I saw those in the live stream, because I will keep up with this. Okay, I'll get the alerts. Today, we're just going to talk about a bit of background on the market today. Not an overall solid day in the major averages. We finally have the COVID vaccine being shipped en masse, the COVID vaccine from Pfizer, and by now it's in all 50 states, and just the first few injections have already been distributed. There was one in on Long Island, where I live, Northwell Health System. Showed one on TV, someone getting an injection. So it's starting, but it's not going to go so fast. So we need to talk about this, because I think everybody is expecting some kind of miracle for the stock market. But I think we just had a huge run in the market to new highs. So let's make sure that when we have expectations for higher stocks, that we actually know what to expect and why we're expecting them. So I'm going to roll the intro real quick. Stick with me for a second, and then we're going to get into a quick update on the day, what happened. I'm going to add perspective to this. So it's not just about a quick update that you can get anywhere. It's about my perspective, and here we go. All right. Thank you so much for joining me. It is a pleasure. It's an absolute pleasure to have you joining me today. And I really want to give you some value here. So when I make my updates, I'm adding a lot of perspective. I've been a financial advisor working with investors, regular, what we call retail investors, people like you and me, for over 30 years. And I've learned a thing or a couple of thousand things along the way. And typically what I used to do every day at about 4:30, I would create like a market wrap with some perspective, and I would distribute it. I just think it's so much more fun to do this in a live stream. Plus, if you are out there and you want to ask me any questions, go right ahead. I would love to answer your questions. So we had a down day in the market today, or did we have an up day in the market today? It could go either way, but I think everybody thought we've got the COVID vaccine, off to the races. Not so fast. I had over 3,000 deaths today. We broke 300. Well, I'm not sure. We had at least somewhere between high 2,000s, low 3,000s COVID deaths today. But the milestone is over 300,000 deaths in the United States attributable to COVID. So yeah, I know some people say don't get into the don't get into the negative news and the nasty stuff, but facts are facts. And to make pretend it's not not happening, just talk about the stock market and what's going on with it, without addressing the issues, no matter how sad and horrible they are, I think I would be doing you a disservice. And if somebody's doing that, some people they have a way of talking about this stuff without really getting into the real problems. And I think we have to talk about those things. So it's a grim milestone. The Dow was down 185 points. The S&P 500 was off. It was off about 16 points, a little under 0.5%. But the Nasdaq had a pretty decent day, kind of makes up for last week's dip in the Nasdaq, and even the Russell 2000 was to hang in there, and the VIX is back to almost 25. That's this one right here. You see that? That's the green. That's the VIX volatility index. We talk about that because that's the fear gauge. When the VIX goes up, it means investing pros, traders are paying more to hedge their portfolios because they're worried about their positions going down. In a way, it's bullish. I would rather see the pros hedge their portfolios than out and out just sell stocks en masse. Okay. So in a way, it's not the worst thing in the world, but it's just a lot of mixed signals because you would have expected the NASDAQ to be up, then you'd see the Russell 2000 go down. The Russell 2000, Rus 2K, that's a small cap stock index. Small companies, a few $1 billion and less in value that are publicly traded in the United States. Smaller companies get more of their earnings and revenue from domestic sources, so they're more sensitive to the domestic economy. So if the Dow Jones Industrials were down, you would think the small caps would be down as well. That's not the way it worked today. By the way, I see you out there, Eric. Thank you very much for joining. And I know Eric is joining me because he gave me a like. So thank you very much. I appreciate that. So if you want a shout out, I can't ask you really. I don't want to be like that and ask, hey, give you like, no, but if you want a shout out, don't be shy. Don't be bashful. Hit me up with your questions in the comments. Let's take a look at DoorDash, Airbnb. These are stocks to watch. So these can continue their descent since going public. You see DoorDash down $15 today. It was in the 180s. Now it's 160. And then you see another one, Airbnb, down $10. It's continuing to go a little lower in aftermarket trading. That was 165. You see that right there, 165. DoorDash was up to 195. I'm not looking to recommend these. I'm not looking to not recommend these. These are just two stocks that I'm watching. These are companies that came public, not at beginner company levels or emerging growth valuations. These are companies that went public as fully developed companies. Probably they went public at prices that reflected a more developed company than what these companies actually are right now. So it bears watching. A lot of people are in these, and I think a lot of people consider these two stocks a sign of the times and crazy overvalued market. So I see Jay is out there. Eric is out there. Thanks, guys. Good to see you. Thank you. And let's just keep going on down the line. We did that one. Let's do this one. Okay. Let's take a look at the FANG-M stocks. Facebook was up a drop, barely up. Apple was down a tiny bit. Amazon had a real good day. Netflix had a great day. Netflix has been getting pounded lately because Disney has their Disney Plus, and there's something like 80 some odd million subscribers already. And a lot of people think they'll match the number of subscribers within a year or two that Netflix has after, since they've been public in 2007. Google was off a little bit. Google had a big outage this morning where YouTube was down and a lot of the other Google services, but it looks like everything is up and running. Google Classroom was down for a little while. I know this because I have kids in high school who have to do remote learning. And Microsoft was up just a touch, but a mixed bag for the FANG-M stocks. And last, let's take a look at the major sectors. These are the ETFs that represent the major sectors of the economy. Technology was the standout leader. And let's just go and see who the losers were. Energy, industrials, materials, and financials. I hate that. I hate to see those four sectors down. Those are the most economically sensitive sectors. Now, these have had a really good run in the last couple of weeks because they were benefiting from that rotation, and that's really what we're talking about. So they benefited from the sector rotation where investors are finally taking profits on their FANG M stock, Facebook, Amazon, Alphabet, Apple, Netflix, Google, and the M is for Microsoft. There's 4 companies in there that are worth $1 trillion plus. So there's been a rotation, though, and you see Zoom came down. I've been talking about this a lot. Zoom came down, and I think there's some negative signals from a lot of these high flyers, because even though we're not going back to, I don't think the world goes back to the way it was before the pandemic. I know people talk about getting back to normal. I don't think normal going forward is going to look exactly like normal did looking backward. For example, office workers will be going back to their offices, but not every office worker. And maybe some companies will say, we don't need everybody here, or we want to have some people in and some people out and keep them in a rotating basis, just to keep that corporate culture and keep people involved and sharp and focused on the company's goals. Some companies have realized that they don't need any office space at all, and office space is just a waste, and they're going to go it alone with that. They're going to go into just remote working. And there will be some companies that say everybody has to come back, and if you don't want to come back, then you have to find a different job. But that's different than what it was before. I think remote working has been on its way for a long time, and I think for a lot of people, it'll work out just fine. So anyway, we saw this rotation, and what I've been saying is we're going to be in this sawtooth pattern or seesaw, where you're going to go into industrials. You'll see those go up, and other consumers, other economically sensitive stocks like consumer discretion, also, building materials, industrials, financials, energy, and then they'll go down, and money will go into the work from home, stay at home stocks going forward. And that's basically what we saw today. That's exactly what we saw. We're just seeing this seesaw pattern, but you don't really see it in the major averages, because even though the Dow is down, the Dow is down 185 points today, it's not really that big of a deal. I mean, the Dow is just under 30,000. 185 points is not what it used to be. I speak to some people who've been in, some of the long tenured investors, let's call them, and they see the Dow down 100, like, oh, holy cow, the Dow's down 100 today. 100 means nothing today. It doesn't really move the needle. So I want to just take a look at something else, and this will be the last thing we look at before we go for the day. We're starting to see a lot of economic forecasters come out with their forecasts, and here's one. CFRA says they're optimistic about 2021 because they expect the economy to do very well. I don't know if you could see this, but their call for the S&P 500 by the end of next year is 4,080, which is an 11.4% gain from about 11.4% from where we are now. Okay, look, that's like standard. Typically you would get 9-10% from the S&P in a year on average. Not that we ever actually get that exact number, but if you go over the long term, you have big up years, big down years, some flattish years. You add it all up, you average it out over years, and you get about a 9.5% average annual return. So to say that, hey, we could be up 11%, not too much of a stretch. But other people, and it's proven that when companies are added to the S&P 500, for example, like Tesla, that's a stock that's partially responsible for the massive investor enthusiasm into tech-related and ESG stocks and work-from-home stocks, they typically do poorly in the year after they're added to the S&P 500. I don't know if you knew that or not. And it's easy to envision for me to see some rising sectors that are economically sensitive. It's called, value investing, cyclical stocks doing better. And it's easy for me to envision a lot of the work from home, stay-at-home stocks not doing as well. When this pandemic started and I was doing this show live last March, people were asking me on the show in the comments, what do I see working in that environment? I said screen stocks. That's what I called them, stocks that keep you on your screen, and you're social media, whatever can keep you on your screen, YouTube. A little later, they became known as work from home, stay at home stocks. I just call them screen stocks. But we had an amazing run in these stocks, and it looks like they've peaked in early September. And since then, they've been dipping, dropping, retreating, whatever word you want to use. Can they go back up? Yeah, listen, anything can happen. But my feeling is that once companies started to break the $1 trillion valuation barrier, it's a lot easier to think of other companies hitting new barriers. So you've got DoorDash and Airbnb that came out at these, 70, 80, $90 billion valuations after they finished their first day of trading. Well, that sounds like an awful lot, right? But if you think in terms of $1 trillion or Apple with a $2 trillion plus valuation, it makes you think that everything else maybe has to be valued upwardly as well. And I think people start to lose a little bit of their common sense in terms of what companies should be valued at. Look, part of the valuation of a company is the I like to call it sweat equity. Other people call it retained earnings, or there's other names for it. But a company that has created the value and the brand and the system and the process that works versus a company that's going to create the same exact things, the company that already did it is worth more because they already paid the sweat equity. They took the risk and they've gotten past a lot of the startup risks. So that's how people are valuing stocks today. What can I tell you? Tomorrow, I'm going to be talking about LinkedIn tips. So I want you to join me tomorrow. That's going to be really good. LinkedIn tips and what I see going forward with social media usage. All right. I'll speak to you soon. Have a great day. And thank you so much for joining me.